Be Wealthy and Smart, episode 378.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about 10 important tax law changes from the Tax Cuts and Jobs Act of 2018 that might impact you. This comes to us from CNBC.com, and it was written by Lori Konish. It says, a slew of updates from the IRS and major tax reform passed by Congress could significantly alter your situation for the 2018 tax year. The IRS unveils its changes each year, including cost of living adjustments for retirement savings and inflation changes for certain tax provisions. Those updates, coupled with new rules passed by Congress through the Tax Cuts and Jobs Act, could result in a big difference in how much you owe. Here are some of the most prominent changes that could affect you. First, standard deductions. This is very good news, by the way. Those who are married and filing jointly will have an increased standard deduction of $24,000, up from $13,000 it would have been under the previous law. Single taxpayers and those who are married and file separately now have a $12,000 standard deduction, up from the $6,500 it would have been for this year prior to the reform. For heads of households, the deduction will be $18,000, up from $9,550. So you can see that's almost a 100% increase in each of the categories of standard deductions. Very good news. Next, personal exemptions. The personal exemption has been eliminated with the tax reform bill. Third, top income tax rate. A new 37% top rate will affect individuals with incomes of $500,000 and higher. The top rate kicks in for married taxpayers who file jointly at $600,000 and up. The new tax law also includes changes to other brackets, and it has a link there to all of the brackets and what they are. Number 4, estate tax. The estate exemption doubles to $11.2 million per individual and $22.4 million per couple in 2018. Number 5, child tax credit. The child tax credit has been raised to $2,000 per qualifying child, those who are under 17, up from $1,000. A $500 credit is available for dependents who do not get the $2,000 credit. Number 6, mortgage interest. The deduction for interest is capped at $750,000 for mortgage loan balances taken out after December 15th of 2017. The limit is still $1 million for mortgages that were established prior to December 15th of 2017. Well, that's really interesting because I did not hear that reported in the press. So all of that noise about the $750,000 cap for mortgages, which caused a lot of flack here in California, was very interesting, but it turned out that they left the limit at $1 million for mortgages prior to December 15th of 2017. So that's very good news. Number 7, state and local taxes. The itemized deduction is limited to $10,000 for both income and property taxes paid during the year. Number 8, contribution limits for retirement savings. Employees who participate in certain retirement plans, like 401ks, 403bs, and most 457 plans and the Thrift Savings Plan, can now contribute as much as $18,500 this year, a $500 increase from the $18,000 limit for 2017. Number 9, savings in IRAs. Savers who contribute to individual retirement accounts will have higher income ranges following cost of living adjustments. Note that the deduction phases out for individuals and their spouses who are covered by workplace retirement plans. For single taxpayers, the limit will be $63,000 to $73,000. For married couples, the phase-out range will vary depending on whether the IRA contributor is covered by a workplace retirement plan or not. When the spouse who is investing has access to an employer plan, the range is $101,000 to $121,000. For individuals who don't have a retirement plan, but are married to someone who does, the phase-out has been raised to $189,000 to $199,000. The phase-out was not adjusted for married individuals who file a separate return and who are covered by a workplace retirement plan. That range is $0 to $10,000. Number 10, contributions to Roth IRAs. For individuals who are single or the heads of their households, the income phase-out has been raised to $120,000 to $135,000. For married couples who file jointly, the range climbs to $189,000 to $199,000. The phase-out was not adjusted for married individuals who file a separate return. That is $0 to $10,000. So there you have it, the top 10 tax changes you need to know for 2018. It sounds to me like very good news. I don't see anything negative in there. I see a lot of improvements. I'm very pleasantly surprised to see these very positive changes. I will link to this article. You can catch it on my website at lindapjones.com. If you haven't yet subscribed to the podcast, please hit the subscribe button, and I'd love to get a review from you. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.